Morning, everyone. Hope you guys are doing well. This is Mike Minter, Chief Investment Officer for Financial Synergies Wealth Advisors, and it is November the 27th, and we're looking back on last week, which of course was a shortened week with a holiday and some abbreviated hours. But hope you guys had a great Thanksgiving. I apologize for not doing a video last week, but I was taking a little break in the country with the family, and the reception was not exactly optimal, so video was kind of out of the question. But I hope you guys are doing well, and so let's jump right into it. It was another good week, so let's look at what occurred. 5-day performance, so again, abbreviated, kind of a shortened week, but still great. Had the Dow Jones up nicely, S&P, Russell 2000 screaming up almost 2%. That's the small cap stocks. NASDAQ tech heavy up almost 1%, and then even foreign stocks starting to show major signs of life. So all in all, a great performance last week. And this month has been just stellar. It's one of the biggest months on record. We got the S&P, I think, up almost 7-8% for the month. And the NASDAQ and Dow Jones not far off of those numbers as well. So really just a fantastic week, and fantastic week and month, and we'll talk more about that in the summary coming up. But year to date is looking great. It's amazing what 1 month can do to turn things around. It's been a great year all overall, but in the last few months things have gotten a bit rocky and things started to pull back a bit. And so it's nice to see that rally coming into the end of the year, and hopefully we can maintain that. But year to date, still great across the board on all indices. Nice change of momentum there. So, and I added this in a couple weeks ago. These are your rates, what I think are just kind of some relevant rates to keep tabs on, and I might adapt these over time. But you got your 30-year Treasury at 4.63, 10-year at 4.5, 2-year at 4.97. So still inverted. Not as inverted as it has been, but still very much kind of lopsided here when you're looking at those Treasury yields. 30-year mortgage did tick down a bit. Actually, everything ticked down a bit last week, and we'll talk more about that. That's part of the rally. Mortgage rates dipped below 8%. Always nice to see for the housing market. So let's get into kind of the story behind that. So falling yields is really the story here that really have driven the rally, in the belief probably that the Fed may be done. We don't know that, of course, but that's a growing consensus. Consensuses can always be wrong, but that's kind of where we are in current sentiment. So the stock market continued to look toward the bond market for direction, responding positively to yields that fell for much of the week. So we had a very successful Treasury notes auction on Monday, and that triggered a decline in bond yields. So the prices were driven up and bond yields came down. So the Fed's latest meeting buoyed investor optimism that potential for further rate hikes was diminishing. So sentiment was also lifted by earnings results from leading AI chip maker that topped analyst expectations, and this kind of is bolstering that narrative of artificial intelligence as potential boost to corporate profits. So it's kind of the new shiny object, the new kid on the block, so to speak. AI is continuing to really bolster that enthusiasm on the market. Despite a higher turn in bond yields on the final half day of trading, stocks still retained the week's gains. So it was a really, really positive week across the board. So let's look at kind of one of the drivers behind that was the latest Fed meeting. So the minutes from the last meeting of the FOMC, Federal Open Market Committee, were released last week, providing insight into its decision not to raise rates and its thinking on the future direction of rates. So the minutes reflected concerns by committee members that inflation remains stubborn and may move higher, and reaffirmed the messaging of many Fed officials that monetary policy must remain restrictive till they're all convinced that inflation will be on track for that 2% target. So we shall see, but still a cautious tone as to be expected, but all in all good. Further, they said that future rate decisions will be based on fresh economic data, as they should be, offering no indication that a rate cut was forthcoming, as many analysts are increasingly anticipating for next year, for 2024. So we'll see if that happens. Again, it's anybody's guess at this point if they actually start cutting in 24. But that would be great to see for the economy, of course, and for bond prices and stocks. So we will wait and see, and of course we'll report to you guys as it's happening. Let's take a look at what's on deck for this week. So we've got some key economic data and some companies reporting earnings. So Monday, new home sales. Tuesday, consumer confidence. Wednesday, GDP. Thursday, personal income and outlays and jobless claims. Jobless claims always a big one. Friday, Institute for Supply Management Manufacturing Index. Tells you a lot about the economy, so we'll be watching those. So a pretty big week for data. Not so much on the earnings side. Not a lot going on here. Dollar Tree on Wednesday. Synopsys. Thursday, Salesforce, Marvel, Dell. So not a whole lot on the earnings front, but we'll take a look at those, see if anything's noteworthy. And as always, we'll digest it and we will report back to you guys next week. Again, hope you guys had a great Thanksgiving and are enjoying the holidays so far. So here is our contact information for everybody out there listening. So give us a call, shoot us an email, or find us on YouTube. Just follow us any way you want, and reach out with any questions or concerns. We're always here for you. Okay, guys, I will leave you with that little light reading disclosures, and we will talk to you soon. Thanks, guys.